Welcome to the Deep Dive. Our mission, as always, is to take a pile of complex, really high-stakes market information, cut through the noise, and give you that shortcut to being properly informed. Today, we're zeroing in on the really intense close we saw on October 31st, 2025. It finished off a strong month, technically, but wow, the narrative felt chaotic, fragmented even.
That's a great way to put it, fragmented. For anyone tracking the end of the week, yeah, it felt like a tug of war, didn't it? A really volatile scrap between two massive forces.
Definitely.
So our deep dive today focuses on that collision course, the one that seems set for the first week of November. We're looking at the sheer power of these corporate earnings, especially tech that's the bulls for our purposes,
Right.
and pitting that against this intensifying, pretty unpredictable pressure from a Fed that looks, frankly, a bit fractured and, well, hawkish. That's the bears.
Yeah, the end of October gave us some serious whiplash, especially if you look at the biggest names, the ones that really move the needle. The market, on paper, closed the week strong, got that multi-month winning streak for the S&P 500 locked in. But you peek under the hood, past those headline numbers, and it's all about this extreme concentration and, real anxiety bubbling up about where monetary policy is headed.
You know, what really jumps out at me looking through all this is that fundamental disconnect. You've got a market where the actual business performance, the profits, especially in high-margin tech, it's demonstrably strong. It looks sound.
Okay.
But then that internal strength is hitting this fierce external headwind. Policy uncertainty, Fed signals. It's a lot. So the victory the bulls got this week, it feels like it's built on, well, an extremely narrow ledge.
Okay, let's unpack this, starting with Section 1.
Yeah.
Friday's fragile victory and the outstanding October overall. So let's get the numbers down first. Friday, October 31st.
Yeah.
S&P 500, it was up 0.26%, closing at 6,840.27 day. NASDAQ Composite did a bit better, up 0.60%.
Right. And that move was pretty crucial, wasn't it? It was a sharp turnaround from that big tech sell-off we saw on Thursday.
It really was.
Yeah.
Felt like a bit of relief, maybe, but the sources we're looking at, they're definitely calling it fragile.
Well, yeah, fragile day-to-day perhaps, but zoom out to the monthly chart and it looks fantastic. The indexes bagged their third winning week in a row, and the S&P finished October up a solid 3%. Critically, like you said, that seals its sixth straight winning month. We haven't seen a streak like that since, late 2021?
Wow, sixth straight month?
Yeah, that kind of consistent momentum, it does suggest there's some underlying strength there, some real buying pressure.
And analysts keep throwing around this term, front-running the seasonal tailwinds. I hear it everywhere. For you listening, what does front-running actually mean here? What are they doing?
Yeah, it's basically market psychology mixed with fund positioning. So November and December, historically, they're often two of the strongest months for stocks.
Right, the holiday rally idea.
Exactly. Optimism about holiday spending, maybe some year-end bonus money flowing into the market, that kind of thing. So when we say the market is front-running, it means the big players, the institutions, they're positioning themselves now at the end of October to try and capture that expected move higher.
No.
They're essentially willing to pay a bit more today because they think there's a high probability that historical pattern, that seasonal strength, will play out again. It shows conviction, definitely, but it also means the market's already kind of priced for good news heading into November.
Right, okay. But that conviction seems to be resting very, very heavily on just a couple of names, doesn't it? And this is where that fragility really comes in. Our deep dive shows Friday's rally was, well, let's be honest, it was basically a one-stock show pretending to be a broad market win.
That is the absolute key takeaway from Friday. Amazon. AMZN. It surged a staggering 9.6% after its earnings.
9.6%.
Yeah, the speed and the sheer size of that move just meant Amazon was, as one source put it, by far the strongest force lifting everything.
Okay.
And the analysis is pretty stark. You take Amazon's contribution out of the equation for Friday. The S&P 500 would have closed down, negative for the day. That tells you right there that while the main index number looks okay, the underlying health, the breadth across different stocks, is actually worryingly narrow.
Yeah, this concentration risk thing, it always sparks debate, doesn't it? I hear the experts say, okay, this isn't 2000 all over again because, fundamentals support current valuations.
Right, you hear that a lot.
But look, if the top 10 stocks are a historically massive chunk of the S&P 500's weight, and the whole rally balances on a knife edge, depending on literally one stock having a blockbuster day, isn't that just systemic risk anyway, regardless of the fundamentals? Where's the tipping point where concentration itself becomes the bubble?
That is the million-dollar question, isn't it? And it's maybe less about the profits themselves and more about the distribution of risk and the potential for failure. Look, back in 2000, yeah, you had companies with insane valuations, triple-digit PEs sometimes, with hardly any actual cash flow.
Right. Eyeballs over earnings.
Exactly.
Yeah.
Today, these mega caps, they are generating enormous, predictable cash flows, high margins. That part is different. However, the risk now is that the market is so tilted towards them that any single point of failure gets magnified across the whole system.
So one bad report from one giant.
Yeah, if just one leader, say, a Microsoft or an Amazon stumbles badly next quarter, the weight they carry is so huge now, it could easily pull the entire index down, maybe 2%, 3% just on its own. The market's efficient at pricing information, maybe, but it's definitely not diversified right now. It's placing this massive concentrated bet.
And that massive bet leads us perfectly into Section 2, the Magnificent Seven divergence. Because the whole investment world just spent 48 hours wrestling with two completely opposite takes on the whole AI investment idea. Created some serious market whiplash.
Oh, absolutely. Whiplash is the perfect word. That group, the so-called Magnificent Seven mega cap tech stocks, they basically split right down the middle.
Yeah.
Based entirely on how they talked about their AI spending specifically, their capital expenditures, their CapEx. And that split became the market's sorting mechanism this week.
Okay, let's start with Thursday's story. That was the bear's view, right? Seeing AI as basically a cost pit. Meta was the poster child for that, sinking a huge 11.3%. I mean, that's its biggest one-day drop in 3 years. Why hit it so hard?
It really came down to expectation management just going sideways. Meta's outlook, it projected notably larger capital spending stretching out into 2026. And they framed this spending as, necessary for their big AI ambitions, building models, data centers, the whole 9 yards. But the market heard that and immediately thought, lower profits in the short term.
Right, the payoff is way down the road.
Exactly. The narrative became Meta's pouring billions into this. The actual return is conceptual, maybe years away. It's just a huge expense that's going to weigh down the balance sheet for, 18-24 months at least.
And Microsoft kind of echoed that, didn't they? They fell, 2.9%?
Yeah.
After reporting their own record CapEx and saying, yeah, spending is going to keep rising.
Correct. So the message coming out of Thursday was pretty clear. AI equals huge costs right now with no immediate guaranteed return on that investment.
Pessimism.
Yeah. The market's first reaction was definitely pessimism. These companies are being forced to spend billions just to stay in the game, and that spending is acting like a drag anchor on their earnings per share. It made AI look like an inflationary force, but on the cost side.
But then, Friday, Amazon shows up and just completely flips the script.
Yeah.
Totally invalidates that cost-focused view, right? Gives us the powerful counter-narrative, AI as accelerated revenue. That's the bull case that lifted everything. Amazon jumps 9.6%. What was the magic ingredient there?
The magic ingredient was proof. Immediate quantifiable proof delivered by Amazon Web Services, AWS.
Ah, the cloud unit.
Right. Unlike Meta, where the CapEx felt like it was about future-proofing Facebook or Instagram, Amazon showed its AI spending was already boosting high-margin revenue growth like right now. AWS growth actually accelerated to 20%. We haven't seen that kind of pace since back in 2022.
Okay, that 20% gross number. Why was that specific figure so electrifying for the market?
Because it showed operating leverage in action. Cloud growth across the tech sector had actually been slowing down for several quarters. People were worried. AWS is Amazon's cash cow, right? It's high-margin, sticky enterprise revenue. So when the CEO, Andy Jassy, comes out and explicitly says AI is driving meaningful improvements in every corner of our business, and then they back it up with a 20% acceleration in growth in their most profitable unit.
Wow.
The market instantly got it. Okay, Amazon's AI spending isn't just defense, it's offense. It's a necessary investment that's already accelerating profitable revenue. It wasn't just spending to keep up like it seemed with Meta. It was spending to immediately boost the top and bottom line. That was the crucial difference.
And that difference, proving the AI spend generates high-margin dollars now, that drove, over $100 billion in market cap change on Friday?
Easily. It was massive. And, we shouldn't forget Apple in all this. It sort of played the role of the anchor, didn't it?
Yeah, good point. Despite beating estimates, forecasting record holiday revenue, Apple actually finished down 0.4%.
Right.
But that was like another sign of that fragility we talked about, doesn't it? Even a positive report from Apple couldn't catch a bid. What held it back?
It really seemed to be the China data. Apple reported a noticeable drop in sales in China. And China is just such a massive engine for them.
Right?
In this kind of nervous show-me market, even a hint of weakness in a really critical region like China, especially with all the geopolitical tension, it's enough to cancel out strong overall results and just cap the stock price.
Makes sense.
And if you look back at the sector performance across those 2 days, Thursday's losses hit consumer discretionary and communication services hard.
Because of Meta and others.
Right. But then Friday's gains, Amazon basically single-handedly dragged the entire consumer discretionary sector back into positive territory. So again, it just confirms that the underlying market health is really uneven, very reliant on a few winners.
Okay, so we've laid out the strength, but also the real fragility of that profits narrative.
Yeah.
But the market isn't operating in a vacuum, right? It's facing this huge macro storm cloud, which brings us to Section 3, the monetary policy headwind and this fractured Fed.
Yeah, the Fed meeting this week, the Federal Open Market Committee, the FOMC, they delivered what the market technically asked for, right? Another 25 basis point rate cut, second one in a row,
Okay.
brings the Fed funds rate down to a range of 3.75% to 4.00%. But the market immediately labeled it a hawkish cut.
Okay, explain that distinction for listeners. What makes a cut hawkish versus dovish? Because the market seemed to be expecting dovish.
Right. A dovish cut is pretty straightforward.
Yeah.
You get the rate reduction and you get clear signals, forward guidance that more cuts are probably coming soon. It signals the Fed is confident inflation is heading down fast.
And the market had priced that in.
Oh, yeah. The market had priced in not just this 25 basis point cut, but it saw another cut in December as almost a sure thing. Like that the odds were over 90% beforehand.
Wow.
But then Fed Chair Jerome Powell steps up to the microphone. He delivers the cut, yes, but he immediately pours cold water on that December expectation.
Right. He explicitly said a December cut was, what was it, not a foregone conclusion?
Exactly that phrase. Not a foregone conclusion. By just removing that certainty, that forward signal, he effectively tightened financial conditions even though he just cut rates.
Huh.
And that one comment, boom, December cut odds dropped instantly from over 90% down to around 70%. So Powell gave the market the rate cut it wanted with one hand, but he aggressively took away the promise of more easing with the other. And that forces a repricing of risk assets because the cost of money isn't just falling. The certainty about future costs just vanished. That's your hawkish cut.
But what's maybe even more striking here is the division within the Fed that spilled out afterwards. I mean, real public disagreement. Dallas Fed President Lori Logan actually came out and pushed back publicly against the Fed's own decision.
Yeah, this is really quite something. Logan basically said she would have preferred to hold interest rates steady. No cut out.
How about reasoning?
Stark. Directly challenging the majority view. She said she believes inflation remains too high, period. And that the economic outlook may be boosted by those strong earnings like Amazon we just discussed, simply didn't justify cutting rates right now.
Okay, so this dissent, it's not just some academic debate point, is it?
No.
You have an actual voting member of the FOMC publicly saying the committee got it wrong. That massively raises the stakes for every single piece of economic data coming out next week.
It absolutely does. It really underscores that the Fed's whole data-dependent mantra, well, the path forward isn't even clear to its own members.
Right.
Think about it. If the jobs numbers or the manufacturing data next week come in hotter than expected, Logan's dissent suddenly looks really smart. It strengthens the hand of the hawks inside the Fed who think they're easing too soon. This internal split just confirms that future cuts are absolutely not guaranteed and makes every data release feel like walking a tightrope with no safety net because there's no clear consensus driving policy anymore.
Which sets the stage perfectly for what we saw in individual stocks this week. Section 4. The market's show-me state. Because with this Fed uncertainty and the AI whiplash, the market has become incredibly selective. Surgically precise even. Rewarding perfection, punishing any weakness instantly.
That's surgical precision, yeah. It's the classic sign of a high-anxiety market. Companies that deliver what the street calls clean beats, beating earnings estimates and giving strong, clear guidance for the future, they're getting huge rewards. Double-digit pops in some cases.
Okay.
But Any hint of trouble, a guidance cut, even a small one, a revenue miss, the punishment is immediate and brutal. There's just no middle ground right now.
Okay, let's run through some of those winners, the ones that delivered the clean beats. First, solar, FSLR, pops 14.5%. Beat earnings, yes, but you said the guidance was key.
Yeah, the guidance was the kicker. They offered a sunnier forecast for 2025. You have to remember, the whole solar and renewable sector has been really beaten down. Higher rates, supply chain issues.
Right.
So when First Solar comes out with not just a beat, but a strong, confident outlook for next year, it signals maybe stability and pricing power are coming back. That triggers a big rotation back into the stock. Analysts rush to upgrade, hence the big jump.
Okay. And Cloudflare, net, up 14.0%.
Similar story, all about the outlook. They raised their full-year revenue forecast to $2.14 billion. That was well above what analysts expected. So proof their growth is accelerating faster than people thought.
Got it. Western Digital, WT's up 9.0%. What was their story?
They didn't just meet estimates, they apparently crushed their Q1 earnings per share. And then they give a really strong forecast for Q2 sales growth, like 20%.
Wow, 20% growth.
Yeah, in a sector like memory and data storage, which is super cyclical and has been weak, that kind of guidance suggests a strong recovery is underway.
Even some newer names did well. Reddit, RDDT, up 7.6%.
Yep, beat on profit, beat on revenue, and crucially, showed strong growth in daily active users, 116 million. For a social media platform, that user growth is the key metric everyone watches for future ad revenue potential. So yeah, all these are examples of companies basically validating their current stock price with clear, positive signals about the future, even in tricky sectors.
Okay, now let's flip it. Contrast those winners with the losers, the ones who felt the market's wrath. Newell Brands, NWL, just cratered 28.0% after results. Ouch.
Yeah, that's a disaster.
But maybe the most illustrative example of this surgical punishment was Dexcom, DXCM.
Ah, yeah, Dexcom, leading medical device maker, right? S&P 500's biggest loser on Friday, down 13.5%. And the reason? It was almost subtle. They trimmed their full-year adjusted gross margin estimate from 62% down to 61%.
Wait, a 1 percentage point trim to gross margin guidance in a healthcare company, not some high-flying tech stock, sends the stock down almost 14%. That seems incredibly harsh. Why does that 1 point matter so much?
It tells you everything about market sentiment and maybe liquidity right now. Look, healthcare stocks, especially established device makers like Dexcom, their valuations are often built on the idea of super stable, predictable, usually expanding gross margins. It's their quality signal.
Okay.
So when a company cuts that margin guidance, even by just 1%, the market immediately panics. It reads it as a sign of maybe unexpected pricing pressure, maybe rising costs they didn't anticipate, maybe tougher competition eating away at their profitability moat.
I see.
And because investors are already jumpy about higher interest rates from the Fed, they demand near perfection. That 1% cut introduced uncertainty about future cash flow stability. That forces investors to adjust their models, apply a higher discount rate maybe, and boom, you get this massive, unforgiving sell-off. The fear of future problems becomes more powerful than the reality of current profits.
Brutal. We also saw straight-up revenue misses get punished hard, right?
Yeah.
Arthur J. Gallagher, AJG, and Charter Communications, CHTR, both down 4.0% just on weaker than expected Q3 revenue.
Yep. Miss the top line, you pay the price. And importantly, these trends continued after the bell Friday. The extended session saw Amazon and Western Digital tacking on more gains. While Dexcom stayed stuck as the top loser, the market is absolutely screaming, give us clarity on future cash flow or else.
The message is definitely loud and clear. Guidance is king, and any slip-up is toxic right now.
Undeniable.
Okay, moving into Section 5. Let's look at the immediate outlook heading into next week. Despite all this concentration risk and the Fed warnings, the bulls definitely ended Friday feeling pretty good. Futures were pointing higher. S&P E-minis up 0.11%. NASDAQ 100 E-minis up 0.38%.
Yeah, that little green on the screen Friday evening signals the market is, at least for now, consciously choosing to lean into that profit story. You know, the Amazon strength, the WBC recovery, more heavily than the policy worries from the Fed.
So they're betting on that Goldilocks scenario.
Seems like it. Betting the economy strong enough for profits to keep growing, but maybe not so hot that it forces this fractured Fed into getting more aggressive with hikes or ruling out cuts altogether. They're absolutely trying to front-run that seasonal strength we talked about earlier, making an aggressive bet.
They're making this bet while dealing with a huge blind spot, right? This ongoing government shutdown. How is that actually impacting the market's ability to even figure out what's going on?
The shutdown is creating a really serious, potentially dangerous data vacuum. key government data releases, especially the big ones from the Bureau of Labor Statistics, BLS. But others, too, they're either getting delayed or just not happening at all.
Okay.
Now, for a market where the Fed itself keeps saying we are data dependent, this lack of official, reliable information is a massive problem. It dramatically increases the potential impact of the market moving power of the few data points that are still scheduled to come out.
So if the usual official stuff is missing, what is the market watching? What are these shadow data points you mentioned that are going to cause all this volatility?
Well, it puts enormous weight on private surveys and non-governmental releases to try and fill that gap. That's your shadow data. Specifically, everyone's going to be glued to the ISM manufacturing and ISM services reports.
Right. The Institute for Supply Management surveys.
Exactly. And the ADP employment report. Now, these are generally respected surveys, but historically, they don't always perfectly match up with the official BLS numbers later on. They can diverge.
Okay.
So any surprise, any deviation from what analysts expect in these reports, it's going to get magnified hugely. It'll be treated as the main, maybe only real-time signal of how the U.S. economy is doing, guarantees maximum volatility until that official data starts flowing again.
Which leads us straight into Section 6, the biggest macro test of them all. The jobs report kill switch. It feels like everything next week builds towards the October employment situation report coming out Friday, November 7th.
This is it. This is the main event. It's the first major economic reality check right after that hawkish cut, and crucially, after Lori Logan threw down the gauntlet with her public dissent. The market, as we said, is priced for things to keep going well. But this jobs report has the absolute power to just shatter that bullish narrative and prove those Fed dissenters were right all along.
Okay, let's game this out. Two extreme scenarios for Friday morning. Scenario 1. What if we get a hot number? Payrolls higher than expected, wages growing strongly.
A hot number would likely be pretty catastrophic for this current rally, for the risk-on mood. It would instantly validate Lori Logan's argument that the economy is running too hot for rate cuts.
Okay.
It confirms Powell's hawkish caution. Any lingering hope for that December rate cut, gone. Odds would plummet, probably below 50%.
And the market reaction.
You'd likely see a violent sell-off in bonds first, meaning yields would spike higher because the market suddenly realizes inflation risk is still alive, and the Fed definitely isn't coming to the rescue with easy money.
Right.
And equities would almost certainly tumble, especially those rate-sensitive areas like tech, maybe housing stocks, because higher borrowing costs, higher discount rates, they just hammer growth stock valuations. It would be a very sharp, very painful reality check for the bulls.
Okay, painful. Now, scenario 2. What if it's a cold number? A surprisingly weak jobs report. Maybe hiring slows way down.
The cold number. That's your classic double-edged sword. On one hand, yeah, it absolutely stokes recession fears, which is obviously bad for stocks long-term.
Right.
But
Right.
the initial market reaction would probably be a significant rally in risk assets.
Yeah.
Stocks would likely jump.
That seems counterintuitive if recession risk is rising.
Because the market would instantly price in a fast Fed pivot. It's all about the Fed put.
Right.
The assumption would be, okay, the economy's weakening. The Fed will now be forced to shift focus from inflation to supporting jobs. That means faster, maybe deeper. Rate cuts are coming.
So bad news is good news again.
In the short term, yes. Bad economic news equals hope for cheaper money from the Fed. While the underlying worry about a recession would still be there, that hope for lower rates boosts valuation multiples, and that often triggers that initial risk-on rally. The market basically bets the Fed will be forced to bail them out.
Got it. And before we even get to Friday's main event, we need to watch those midweek shadow data points closely, right? To gauge the mood.
Absolutely critical. Monday kicks it off with the ISM manufacturing PMI. That gives us the first glimpse of how the industrial side of the economy held up in October.
Okay.
Then Wednesday is a huge day for data. First, we get the ADP employment report. That's the big private sector payroll number everyone watches now. And then later Wednesday, the ISM non-manufacturing or services PMI.
And services is key because
the services sector is by far the largest part of the U.S. economy. How consumers are spending, how service businesses are doing. Any sign of strength or weakness there will massively shape market sentiment heading right into that official jobs report on Friday. It's a crucial stepping stone.
Okay, so we've covered the huge macro policy test hanging over everything. Let's pivot back for Section 7, the micro test. Because the market also needs confirmation from AI's second tier of companies, right? The Magnificent Seven split was dramatic, but now we need to see if the suppliers are confirming that growth.
That's exactly right. The spotlight shifts now to confirming that Amazon-style profitable growth story. Is AI really boosting everyone's boat, or was Amazon somehow unique? We need proof that all that CapEx spending we talked about is actually flowing down the supply chain efficiently and, crucially, profitably.
So which specific company reports are central to either proving or disproving that profitable AI growth idea next week?
Well, the real AI narrative test hinges on reports from companies like AMD, Supermicrocomputer, that's SMCI, Palantir, PLTR, ARM Holdings, and Qualcomm, QCOM.
Okay, why those names?
Because they're the critical layer below the hyperscalers like Amazon and Microsoft. They sell the chips, the specialized servers, the software, the core infrastructure that enables AI. Their results, and especially their guidance, will tell us, is the demand from the big guys still accelerating? Or is it maybe starting to slow down, raising that ugly specter of the meta-style cost sink again?
Got it. And we also have a consumer health check happening this week too, right? Which is obviously important for the Fed. Reports from Uber, Shopify, Airbnb, McDonald's.
Yeah, absolutely vital read on the consumer. The Fed's been trying to engineer this soft landing, slow down demand without crashing it. So reports from these companies, ride-sharing, e-commerce, travel, fast food, they give us a real-time pulse check on whether the average person is still spending or starting to pull back.
Okay, if you had to pinpoint maximum volatility next week based on earnings, where would you look?
Tuesday. Tuesday, November 4th, looks like a potential super catalyst day, especially after the market closes, because that's when we get the two most important AI infrastructure reports of the whole week.
Which are AMD and Supermicrocomputer, SMCI. Why are those two so critical coming right after that Amazon Meta divergence?
Because they are the immediate demand signal for the actual AI compute hardware. AMD is NVIDIA's main challenger in AI chips, right? Their guidance basically sets the tone for the entire AI hardware spending outlook into 2026.
Okay.
And Supermicro, SMCI, they build the high-performance servers that house all those expensive chips. They're seen as a key bellwether for data center demand. So if either of them signals any weakness, maybe a cautious outlook, hints that the big cloud companies are tapping the brakes on spending.
Like the meta narrative again?
Exactly. If they hint at that meta-style caution, it could stop this whole tech rally dead in its tracks, because the market would immediately fear that this massive AI spending boom might already be peaking or cooling off. The stakes are incredibly high for those two reports Tuesday night.
Wow. And the volatility keeps rolling into Wednesday.
Oh yeah. Wednesday gives us McDonald's during the day. That's a huge read on the consumer across different income levels. Then after the bell Wednesday, more critical semiconductor reports. Qualcomm, QCOM, and RM Holdings, ARM.
Qualcomm is important for.
Mobile phones, primarily. Their outlook is vital for gauging demand for smartphones and other connected devices. And ARM is unique because of its licensing model. Its results give you a broad insight across the entire chip design ecosystem.
And then we wrap up the really high-impact earnings Thursday night with Airbnb.
Yep, Airbnb gives us that final look at discretionary consumer spending, especially in the travel sector, which has been pretty resilient. So yeah, it's just a relentless week. Micro-level earnings tests are perfectly colliding with these huge macro pressures. It's set up for maximum market tension.
Which brings us perfectly to our outro,
Yep.
the conclusion of this deep dive. The bold, dangerous bet. We definitely ended the week with some upward momentum, didn't we? But that central conflict is just crystal clear now.
Yeah.
The market seems to have placed this very narrow, very bold bet that profits, especially from a few tech giants, will keep accelerating. And it seems to be largely trying to ignore these flashing policy warning lights from a Fed that doesn't even agree with itself.
It really is a profound bet, and it's a bet on a very specific, very optimistic, and maybe narrow path to success. That positive momentum we saw in Futures Friday night, it's real. But we just have to stress the immediate dangers here.
Right.
This rally, as we've said, it's built on maybe the narrowest foundation we've seen in a while. And the economic landscape for this first week of November, it really does feel like a tinderbox. You've got these make-or-break AI earnings tests crashing right into this critical data-starved jobs report. The slightest thing goes wrong, corporate results disappoint, or that economic data surprises badly, the risk of a broader stumble feels really high.
Yeah, that confluence of events, it just means the market is carrying this fragile momentum into November. So for you, the listener, you really have to weigh these competing forces.
Look, the market closed October on a high note, no doubt. But it could be just one hot jobs number away from facing that hawkish cut reckoning we talked about. That single data point on Friday morning, it really holds the power to validate those Fed dissenters, potentially send bond yields soaring again, and knock risk assets right back down as those discount rates adjust higher.
So as you get ready for this crucial first week of November, the big question you have to ask yourself is, which story do you believe holds more weight right now? Is it the fundamental, maybe accelerating power of these concentrated corporate profits? Or is it the looming external threat of this restrictive, uncertain, and fractured Fed policy?
That really is the question, isn't it? The answer will likely determine whether it's the bulls or the bears who truly control the market narrative as we head towards the end of the year.
Thank you for diving deep with us today. We'll catch you next time.